index is at. That's the, I mean, it's absolutely unchanged, flat, whatever you want to call it, across the board, except the small cap space, but there is a little bit more pronounced kind of move on the downside. More up than down though, 30 up and about 20 down. That's the Nifty heat map, which is coming up on your screens right now. 56 points, so looking a little better on the Nifty, about a 0.25% higher, 24,774. Surabhi.
Okay. So now it's actually a 50-point move on the upside, looking good. What's up? Power Grid, about 1.4% higher. By the way, you're seeing a very different rate on Bajaj Finance today, right? Because stock is looking at a 4:1 bonus and a stock split as well. So therefore, the price has adjusted. Bharti Airtel 1% higher. Cipla is about 1% higher. L&T is managing 0.5%. BEL, Ultratech Cement, so lots of stocks. And actually, even the Bank Nifty's turned positive. Now, it was red, but it looks like it could be changing direction. HDFC Bank, for instance, up about 0.5%. HCL Tech, Infosys. So actually, it's a wide recovery, you'd have to say, overall. And it's cutting across tech, some IT names, some economy names like L&T as well. On the downside, Sun Pharma is lower by about 0.5%. Market is going through the interpretation of the latest observations for the Halol plant for the company from the US FDA. Reddy is also lower, about 0.5% on the lower side. And then there is Coal India, which is a little weak. Other than that, now the bias seems to be getting positive. 60 points up on the Nifty.
Well, that's right. So we keep an eye on a couple of names. SCI has moved up. That's up close to around 6-7%. So big up move is what you're seeing on that name. Vedanta is another stock that's moved up. Remember, they have that, meet for dividend payout in the next 2 trading sessions. And the oil price spike as well bodes well for that. So that's up close to around 1.5%. Besides that, keep an eye out on PI Industries. We had made this point in the second half of trade, even on Friday. Quoting an Equirus note, well, they said that, in fact, the export data was very, very strong out there. And take a look at the move you're seeing on PI Industries. Big move out there. Stock up close to around 4%. For the first 2 months, that's for April as well as May, you had the revenue number, export number, that was up by 20%, and Equirus was factoring in a 30% uptick in terms of EBITDA. So clearly, they are factoring better operating performance. Besides that name, another couple of big stocks that are moving. You have FDC from the broader markets. That's up close to around 9%. I'm not sure what's the news piece on this one, but that's moving very, very well. And Eris Life Sciences, that's another name that's up close to around 5%. So big move is what we're seeing on both these two stocks in today's trading session. On the flip side, Blue Spring, that listed last week, that continues to be at lower circuit. That's down close to around 5% or thereabouts. But you have to say that it's actually an encouraging looking start to trade. The Nifty is up close to around 80 points. The 20 DMA comes in at ballpark, 24,835 approximately. So you want to keep an eye out on that mark. And the Nifty Bank, you'll want it to get closer to around the 20 DMA as well. So good start to trade.
Yeah, no, absolutely. 80 points now on the Nifty. So we've got, 24,800 coming through. Lots of momentum, individual names. Reliance Power, for example, I think it's up 70% this year. It's up another 3% this morning, almost 69. Second largest volume traded gainer coming through this morning. MCX is up about 2.5%. That is our power. Look at 3.6 million shares now. MCX is up 2.5%. MCX, of course, had a move last week as well. So third largest volume-led gainer. HBL Power, basically, 4% higher. Fifth largest volumes on the NSE, at least at the word go. GE Shipping is up, coming up with 2.5% gain. Shipping Corporation, of course, 4. GE Shipping is up 2.5%. Bellrise, by the way, recent listing, that is coming up with a 3% pop at this stage. What else? I mean, Midhani is up about 1.5%. You go down the list, there's more, but I mean, point is volumes dry up very fast. Cosmo First, right? I mean, it's basically seen a little bit of consolidation, but it's up 5% this morning, although volumes are not very large at this point in time. So that's the overall picture. Jubilant Ingreva had that massive move on Friday. It basically moved up from 680 to about $800 on Friday. It's coming off a little bit, just 2.5%, but it's got volumes in it, so that's why I'm mentioning it. HDFC AMC is down about 1% or so. Intellect is down about 3% or so as well. So that's broadly the lay of the land as far as the market open at this point. Shiv Puri is with us, founder and managing director at TVF Capital Advisors. Shiv usually sort of comes on and joins us from Singapore, but I think he's joining us from a very hot and sweltering Delhi. Shiv, good morning. Good to have you with us here. Come to Bombay. I think it's much better weather. It's raining and it's monsoons are finally here. I think you are coming. So,
Yes, I am. Yes.
how are things going, Shiv? I mean, markets, of course, doing their own thing, and despite all the turmoil in the world, equity markets pretty unaffected. At least the big global markets largely unaffected in that sense, right? Dips have been shallow, swift sometimes, but very shallow, short-lived, and always money looking to buy, especially here in India. What's your assessment now, Shiv?
Well, I think globally, if you look at it, the biggest worrying factor is really geopolitics. And as long as geopolitics remains localized, it doesn't become a global problem, markets are seeing past it because earnings are still pretty good, at least in the West. In some of the big tech names, earnings have done very well. Here in India, you're seeing the last 1 year where earnings have slowed down. But as I look forward, you've seen a few things happen that I think will be quite constructive for the markets. So first is that liquidity in the system has gone up. You've seen the Reserve Bank cut interest rates, cut CRR, and that's an important factor. Second is you're starting to see pickup in rural consumption, which is always a good thing. Third is government capex seems to be coming back on stream again. And the two other areas, which is private capex and urban consumption, are the only two things that I think have plateaued. And a lot of that is because a lot of urban consumption is because of the tightening by the lenders for unsecured lending. So if you look at the layout for the next sort of year or 2 years, the backdrop seems pretty constructive. And finally, I'd say, come September and December, you'd see that in the base effect as well, because that's when you really saw the earnings slow down last year. So you'll have a favorable base as you go later in the calendar year.
Yeah, and then maybe, eventually those earnings numbers start looking good. Shiv, good to have you on the show this morning. Thank you for joining in. So since you sound fairly optimistic and constructive on equities, including perhaps India, what's the approach to the market now? What parts to buy? Where do you still see some semblance of, let's say, valuation sanity, if not valuation comfort?
Yeah, so they say you need three things to have a constructive market, right? You need liquidity or easing liquidity, which India has. You need a good long-term fundamental story, which India has. And you need cheap valuations, which India does not have. So it's the third part that is going to be a little bit of a limiting factor in terms of returns. But if you look at valuations, there's quite a big disparity between what you see in the large cap established names versus what's happening a little bit in the mids and the small cap names. And I've always had this fundamental view over the last 2 decades that the big companies do end up getting stronger. And we're seeing that. We see companies in India with 20, 50, $100 billion market capitalizations, growing at very, very healthy rates. So if you're seeing sort of the larger cap names, the names in the indices continue to power ahead, I think that at reasonable valuations is a pretty good place.
Let's get to your top sector focus then, Shiv. What are you bullish on? I recall, in the past, we've spoken about that IT a little bit cautious on that space. And that's been pretty much on the ball with regard to that call. Currently, how are you placed in this evolving global landscape? You have Trump's tariffs that are at play, geopolitical issues as well. Which is the sector you're most comfortable on?
Well, I think more than sectors, there's a lot of opportunity on a bottoms-up basis, which is the way we've always thought about investing globally. And if you look at but sectors, financial services, healthcare, especially hospitals, consumer discretionary, are probably three areas that are looking pretty good. I don't think much has changed. When we were talking about a year ago, I was talking about the same things. So I think that still looks pretty good. And there are, different pockets of interest. You look at the online recruitment space. There is a particular company that's, continues to do well, and that has diversified its business. So you have to just look at some of these bottoms-up opportunities. But I would highlight those 3 or 4 sectors.
Shiv, that second point that you said that a bull market needs 3 things, good long-term story, liquidity and valuations. That second point, liquidity, let's face it, the money that mutual funds were getting every month, those flows have halved from the peak. It's still not hurting because the SIP book is very, very strong. But could that become a concern if the market doesn't rev up again? Because FPI flows have been patchy at best. Your thoughts?
Yeah, so I think liquidity is two parts, right? One, of course, is flows, but the second is what the Reserve Bank does, liquidity in the system, which has been very tight the last few years, but now has loosened considerably. So it's also liquidity in the economy, and that's sort of where I was coming from more.
Yeah, and
Okay, take your points. We're talking more from a monetary markets point of view. But just to complete, my question was really that we don't have very strong MF flows as of now. And foreigners, I mean, we keep hearing that India is a great long-term story, but we're yet to see a very consistent one-way move in terms of foreign flows.
Yeah, but I think one of the things we've seen in the last few years, right, is the dependence on foreign flows has declined significantly for the strength of the Indian equity market. And maybe over the last few months, things would have slowed down, but we've also come off very high numbers. In absolute terms, the numbers are still very strong. I don't think significant more liquidity from a flow standpoint is needed into the equity markets. Once the economy starts picking up again and you're starting to see the conditions perhaps laid out for that, and the equity markets start responding, typically capital tends to flow with a little bit of a lag.
No, absolutely. Point taken. So the three areas, right? Financial services, hospitals, I remember you've had a long-held view, and consumer discretionary. These are the three buckets where you are looking at looking for opportunities. Financial services, I remember, it's all large caps, right? In that sense, Shiv? I mean, it's a place littered with lots of accidents, across, banks, NBFCs, MFIs, except the top tier in that sense. And that's where those are positions you hold?
And that's exactly the opportunity, Prashant, in financial services. It's because it's littered with accidents, the ones that do not get into accidents tend to compound really well over the long term. I mean, very few people would realize that over the last 12 months ending March, the fiscal year ending March 2025, the largest private sector bank was the best performer in the Nifty. So it's also a case where if you avoid the accidents, you actually get significantly ahead.
And just to revise your thesis on hospitals and what you own here, and how are they looking now? Because, I mean, lots of names have run up. Even some of the what used to be laggards, Narayana Health, etc., new all-time highs, strong performances over the years. What's the thesis now?
Well, hospitals as a category actually is a very tough business, and it's historically not done well globally. But in India, we have a few things that are different. Number one is highly underpenetrated. And so if you have quality care at scale is very important. So brand and scale really matter in this business. And you're able to build clusters in the major markets that have established need for healthcare. If you're able to attract the right doctors, therefore attract the highest paying patients, it becomes a virtuous cycle where the return on capital can be very, very high. And it's one of those industries I think you look at in India and say, if there were a few more hospitals or a few more hospital chains, you don't see the beds will be lying empty. The beds are lying empty if there's a problem with quality or consistency in healthcare that's provided.
Valuations are still okay, Shiv?
Valuations there have run up a bit, but I think, again, it depends on how the company is allocating capital. There are very few companies who are doing it smartly, where they are becoming effectively quite capital light through brownfields, through management contracts, etc. And so, the downside on hospitals is it's a capital intensive business. And if you're able to solve for that, it becomes a very attractive business.
All right, Shiv, final question before we let you go, leading into our next discussion on real estate. What's your thoughts on the theme, the real estate theme here in India? The developers who join us on the channel say they're in the initial years. Some believe that maybe we're in the latter years. How are you placed on the real estate stocks? And also, if not the real estate stocks, do you have a view on the ancillaries, say the pipe makers, cement, or the likes?
So we've never done anything in real estate, so I can't really comment on that. But in terms of the ancillaries, I think the important thing to keep in mind out there is what is the moat of the business? What's the barrier to entry in that business? There's certain ancillaries where that's very high and they've done very well. But in most cases, it is fairly commoditized. And pricing tends to be the decisive factor, which makes the business a lot less attractive. So to me, that's the number one thing to keep in mind for the ancillaries there.
Shiv, consumer discretionary, the third one, which you kind of alluded to. Talk to us about what exactly are your ideas?
Well, so over there, if you look at, perhaps one of the most successful retailer in India, it's a very difficult business, retailing. And if you get it right, some of the wealthiest people in the world globally, whether it's the Waltons or whether it's the Adidas family or whether it's the Aldo family, etc., have done it through retailing. And it doesn't necessarily have to be grocery retailing. That's not the only way. But there is a retailer who's I think really started to crack the model the last few years, and the upside there is huge because the market's very underpenetrated at the moment.
For educational purposes, nothing else. Shiv, which one? Sorry, which one are you talking about? Are you talking about the whole spectrum? You're talking about Trent or Titan or?
Well, I can't talk about names, Prashant, but I think you're on the right path. Your guesses.
Okay, all right. Got that. I think we'll leave it there, Shiv. Good speaking with you. Appreciate you joining us and running us through that view. Helpful. I mean, in terms of when you sort of look through the day-to-day moves, to have a framework in mind. And I think Shiv has provided us with some of that, especially as far as financials and healthcare and especially consumer discretionary retail is concerned. So that's Shiv Puri of TVF Capital. Markets are up about 60 points. 24,774 is where we are at, guys.
Okay, all right. So the market's actually doing better than what the pre-open session was indicating. Seeing some stability on the green side, at least for now. So the next sector that we're putting on the radar is real estate. And specifically, we're talking about Prestige Estates. Now, Prestige had, a bit of a, if you can say, lackluster, not such a great year FY25 because a couple of the launches and projects got delayed. Which is why for the full year, the new sales picture was slightly lower. But their guidance is very strong for the current year, FY26. They're saying that the launches planned are for 44.8 million square feet, almost 45 million square feet, compared with about 25.5 that they did in FY25. And likewise, their pre-sales target is 27,000 crores for this year. Mr. Irfan Razak, Chairman and Managing Director of the Prestige Group, is with us. Mrs. Razak, great to have you on. So that's what we really want to try and understand, that, the nuts and bolts behind the numbers and where the optimism comes in from. Can you take us through, what's going to drive it? You've been launching a lot of projects here in the Mumbai market as well. NCR is a market. You've got a JV going in Chennai. So what makes you optimistic that the development this year, the pre-sales this year, will be substantially higher than the last one?
Good morning. Thank you. Actually, we had to bring in a lot of inventory in the last financial year, which got delayed because of various reasons like approvals, RERA number and other stuff. But that's behind us. And this quarter itself, current quarter, we've done a lot of launches, especially our NCR project, which is the Prestige City Indirapuram, and that's done extremely well. And we have a slew of launches that are lined up in Bangalore, in Chennai, in Hyderabad, as well as in Mumbai. So all this sum total of that, we are pretty confident that the guidance that we've given this year will be surpassed. So that's the whole idea. In fact, this current quarter has also been a strong quarter, and I believe it will be one of the strongest quarter the company has had ever. So this helps us in that confidence. As I said, we've launched the Prestige City Indirapuram this quarter, and we've did the Prestige Gardenia Estate, a plotted development in Bangalore. Now we're gearing up to launch the Prestige Pallavaram Gardens in Chennai, and a whole lot of other projects as we go along. And there's a lot of excitement in the system. The market is good. Okay. Basically, there is demand, and there are people who are ready, willing, able to buy and to invest, and that gives us the confidence.
So that's an overview on the year. I just want to get a broad sense on pricing as well. Then we'll get into the various factors, including what you're saying is a strong Q1. Last year, your average realization across the portfolio, I believe, was around 14,113 to be very specific. So 14,100 rupees, give or take. which was substantially higher than the previous year. What is pricing telling you in all of your different key markets? Is there further elbow room? What is the kind of price appreciation you'd expect across the portfolio this year?
See, we do not want the price to run away very fast, and that's not good for the market, not good for the consumer itself. So our endeavor has always been to see that when we bring our product to market, it's priced sensibly. The company's bottom line is protected. At the same time, the affordability is not breached in terms of the buyers. Now, this is a challenge. Yes, land price has gone up, the construction price has gone up. So we have to sort of do the balancing act and make sure that the size of the product is right. At the same time, the ticket size has to be affordable. So it has gone up. There's no doubt about it that the price, if you look at it per square foot or ticket size, price itself has gone up. But then we don't want it to breach a barrier that it becomes, the product becomes completely.
So a range, maybe some rough range. I understand that your intention is not to really squeeze out your buyer. But given the realities at hand which you describe, I mean, 10%, 15%, single digit, what's the kind of price rise that you think will be palatable?
I mean, I won't give a percentage like that, you see, but if you ask me now, it depends. Each segment of the market has a different pricing. Now, if you take the luxury market, it's a different, acceptability on the price. If you take the mid-market, even a single-digit price hike also will be a problem. So I believe that the balance has to be there. And if you ask me, in the mid-market, a price increase between 5 to 7% is imminent, and it'll happen. And that's where we'll try and control it. And of course, in the luxury market, it'll be much larger.
Got that. Mr. Raza, good morning. Always good to speak with you. Prashant here. The big Indirapuram project, sir, could you give us what is the status now?
We've launched the project, 2 components of it. The last component, Mayflower, we've just logged in for RERA. We're waiting for that. All 3 components of the project is totals to about 4,000 units, out of which 3,400 have been launched. And it's done well. I mean, there has been a good response, and people have responded positively, and the numbers are pretty healthy.
3,400 out of 4,000 have been launched, and is it possible to define? I mean, when did all of them go online in terms of being launched, and what's been the response quantitatively? If you can give us a sense.
Yeah, I mean, to give you numbers, we launched 3,400 units. That was in this quarter itself. And we are pretty happy to tell you that we have almost sold 2,800 to 2,900. The numbers could vary because there's a dynamic change every day. But that's the level of sales that have happened, and that totals to quite a large amount of sales, which is 7,000 plus crores only in this one single project. And also the collections on this project have been pretty strong.
All right. Hi, Mr. Razak. Good morning. Good to see you in. Nigel on this side. Sir, a couple of quick questions. Prestige Hospitality Ventures, the DRHP you have filed. By when do we see the IPO?
See, we filed the DRHP. Now we are waiting for the nod from SEBI. As soon as the nod comes from SEBI, the bankers are working on it. All the compliances have been done. And we believe that if everything goes well, we could hit the market as soon as we get the SEBI nod.
So sometime in the middle of this fiscal would be a fair guesstimate?
Yes. We are trying hard to see that we bring it in this fiscal. If possible, maybe in the next quarter itself. Okay.
And what kind of quantum of money will you be looking to raise?
Yes. In this, there'll be 2 parts. One is an OFS and the other is a dilution, primary dilution. All put together, we'll be looking at about 3,500 plus crores.
All right. And that brings me to what is the current debt in your books and what kind of capex have you lined up for this year?
On the hospitality side, there is substantial capex, but then now the way we have planned is to, the whole objective of this issue is to see that we clean up the entire debt in the books that is available for the hospitality. And that gives us elbow room to do further acquisitions if we, as and when the growth capital will come. So that will help the cause of the company itself. And we have a slew of operating assets. At the same time, the largest asset that's under construction, which we hope to complete, is the Delhi AeroCity Hotel, which is St. Regis and the Marriott Marquis. And that's the largest hotel in the country in terms of keys. At the same time, it's a big convention and exhibition center of 225,000 square feet.
Okay. All right. Very quickly, what about the Pali Hill project? That's a much awaited, one of the newer projects, newer geographies that you got into. How much of it has already been sold out? You have a celebrated Bollywood couple opposite, Ranbir and Alia have moved in. How much of it has already been sold out, and by when do deliveries start getting rolled out?
Yeah, see, Pali Hill is actually the smallest of the projects that we are doing in Mumbai, and the most challenging because the terrain is such. And we've, like you rightly said, we've got high-profile people living all over. So the overall construction time itself that it takes is slower than what you would do in a normal development. But the good news is that we finally got out of the ground, and the structure started coming up, and that should take us another couple of years to complete. Having said that, we are happy to say 2 weeks ago, we completed 3 developments in Mumbai, the first of it by Prestige. One was the Prestige Jazdan Classic, which has got the occupancy certificate and ready to start taking deliveries to customers. And the Prestige Siesta Tower in the Mulund component of Prestige City. And that also is completed, and that's 400 odd units. And then it's the rehab office building in Mahalakshmi, which is called the Prestige Turf Tower. Even that has been ready. So we have managed to, in the short span of about 4 years, complete 3 large developments. And all these developments are ready for delivery. And we are at it, and many more in the pipeline, including the daffodils, which is the Pali Hill. And in terms of sale, that's done well. We've almost sold about 70% of the stock.
Okay. All right. Lots of stuff coming up here. The skyscraper, the sky is littered with the ongoing construction. Maybe with rains here now in full flow, perhaps maybe a little slow, but I think otherwise it's been a really under construction city in all ways, more ways than one, with developers, but also the government really now cranking up on some of these projects. Thank you very much. Appreciate you joining in and running us through all of those details. That is, of course, Prestige Estates in focus. But we're not going to stray too far away from real estate, Nigel, to cement now.
Well, that's right. Let's focus on cement. Earlier this month, the West Bengal government, they invoked the incentives for cement players. How does this development impact various businesses? What's pricing, demand trends as well? To discuss this and more, we're joined by Mr. Sandeep Ghosh, the Managing Director and CEO at Birla Corp. Hi, Mr. Sandeep. Good morning. Thanks a lot for joining in, sir. Let's talk about the good news first with regard to the green signal, with regard to that limestone mine that you'll have got. How does it help you all in terms of visibility? And with your current limestone reserves, how much can you expand capacity organically?
See, Nigel, there is not much of a change. We don't change our strategy quarter to quarter. And I thought that's something you and the market should give us credit for, because we have stated a strategy and we, stick to it, and that's stay on course. And that's been, so this particular, mining thing, don't see that in isolation, this acquisition. These are all part of our longer term strategy in terms of protecting our place in securing our existing markets, and in due course making organic growth. So this is nothing I would look at immediately. This is part of a large continuum, and no dramatic change because of this one particular auction bid.
All right, got that. So that's out of the way, but it's a step in the right direction because your raw material gets secured. So that's good news, I guess, from a longer-term standpoint.
That's the point to note, Nigel. We had indicated to the market that after consolidating, getting ourselves to a certain place, then we will look at new expansion, whether it is brownfield, greenfield, and expanding. And our objective is to secure our core markets over there in value terms, and then also expand in our adjacent or the secondary markets. And that is the direction we are moving. and in line with the guidance which you provided consistently.
Okay, all right. What about these incentives, the issue that's crept up in the West Bengal government? What's your comment on that? And were you all factoring that in, or you all were not factoring it in the first place, so it doesn't change things big time for you all?
See, we've been waiting for it for a long time. Nobody can blame us on patience. And so we are patient also to see, because we are not the only people affected. There are a lot of people with much larger stakes have been affected. So I don't think it's played out yet, or we have heard the last word on it yet. So we are also observing the situation and seeing how it progresses and what are the options. So right now we are not particularly, rattled by this particular development.
And you don't think it'll have a contagion impact? If I remember correctly, I think on a yearly basis, your incentives are to the tune of around 100 crores, right?
See, this is particularly only you're talking about the West Bengal. West Bengal, our incentives had ended long time back. So this is all pertaining to the past.
Okay, all right. But you don't believe that it could have a risk on other states as well, right? A contagion impact?
I don't see that happening. This is very exceptional. And all other states, I think they have been pretty good at meeting their incentive commitments.
All right. For the industry, I wanted to understand, how do you read things, because you have exposure to various parts, central, north, parts of east as well as west. How are the demand trends? There was some kind of softness. I'm looking at a DAM Capital note earlier this morning, and they're suggesting that demand hasn't been that great because, you had an alteration with Pakistan. There was some delay in terms of spends. But how do you read the demand situation? And also, what about pricing? The hope is that FY26 will be a far better year for cement prices. Do you believe so?
See, FY25 was a washout.
Yes.
That's a very abnormal year. So obviously that cannot contain. Now, when you talk of prices, I'm not the one who really looks at a very bullish situation. I think a nominal increase in prices, if it sustains through the year, that'll be good for the industry. We had a fairly good exit point, and if somewhat an improvement over that, if we continue to do without any major slides in this next 2 quarters, then I think the industry will be on a good footing.
What about the JP Cement asset? You have already laid out your plan to go from around 20 million tons to around 28 million tons. And the capex as well, you have already outlined around 4,300 crores approximately. There's a JP Cement, that there have been bids that have been invited. Are you part of the bidding process? Have you submitted a bid?
We are not at all part of the bidding process. We haven't, that's far too big, far too complex for a company of our size to look at. And I think it is for the big boys, big players, because it's coming as a composite, offer. So somebody will have to have the ability to unravel all parts of it. And that's not really our cup of tea.
You're doing organic expansion around $80 per ton, roughly $80 to $85 per ton. At what kind of pricing would it make you interested in an inorganic opportunity? Because the problem is, for organic, it still takes a couple of years. For inorganic, it could be relatively faster, though you may have to pay a bit of a premium. So your thoughts on that?
I don't see too many inorganic opportunities coming our way, Nigel, to be honest, because it has to have a clear fit for us in our relevant geographies. And I don't see anything coming their way. And right now, it's because we are committed to the brownfield expansion, etc. We cannot abandon it at this juncture. So we'll have to be, if something really, really attractive comes, just like the way Reliance came a few years back, we may have to look at some innovative solution. But right now, I don't think that's taking up too much of our mind space.
I recall that big breaking announcement came in post-market hours. It caught people by surprise. Anyway, let's focus on this year then. FY26, as you said, nothing much has changed. But in terms of an outlook, both in terms of volumes, industry, I think people are working with mid-single digit to high single digit growth. How much will your company grow in terms of volumes, as well as EBITDA per ton? Last year was a washout, but the past quarter was very, very good in terms of an EBITDA per ton. What kind of a run rate will you maintain?
Nigel, I don't have to repeat anything within a month. You spoke to our CFO less than a month ago, so our projections have not changed, and that's what I told you. So we are, in terms of growth rate, the market we're expecting, as you said, 7 to 8% growth, and that's what we will also grow in terms of volumes. In terms of EBITDA, I would not comment at this juncture.
Got it. Thanks a lot, sir, for joining in and giving us all of those details on terms of a broad outlook on the cement space as well as for your company. Appreciate you speaking to us here on CNBC TV 18.
Thanks so much.
All right. Well, that's the cement discussion, and focus markets, by the way, are absolutely flat. There's nothing at all on it. 24,700 is where the Nifty is at. And look at the market breadth, by the way. It's now completely turned. So 2,000 stocks are lower and 500 stocks are higher. So this is the exact opposite of what it looked like in the morning. The Nifty Bank, by the way, is down 100 points, which means it's down about 0.25% at this stage. So, sorry, Surabhi.
No, go on. I was just saying that even for the large caps, mid caps, of course, the index is down a whole 1%. But even the large caps, and we were... in the market conversation earlier, the Nifty was up 80 points. So it's just not been able to hold at all. It's
not been able to, and I think we're flatlined now, absolutely, literally flatlined. Now, the big story, global story, of course, is, the entire Middle East flare-up conflict, and it's not, targeted in that sense. It's spread out, getting spread out even more between Iran and Israel. Is it going to impact shipping lines in any meaningful way? So let's get some perspective. Sunil Vaswani is with us, Executive Director at Container Shipping Lines. And he's, of course, the association. And Dushyant Mulani is President at Federation of Freight Forwarders Association in India. Gentlemen, good morning. Great to have both of you here. Appreciate it very much. Prashant here. Sunil, if I can start with you, if you can give us some context. So as viewers here, what's happening globally? The big one, of course, has been this the Strait of Hormuz, which has never been closed, but it's not a non-negligible risk because if things happen which have never happened before, who knows what can happen. We've had President Trump, for example, saying, well, we'll have peace. Then he's saying, sometimes things, people have just got to fight it out. So no one really knows which way this is going to go. But just give us the state of play for shippers. How does this work out?
So morning, and thanks for having me on the show. Now let's break this up into two parts. As far as the shipping lines are concerned themselves, we are rather living under uncertain circumstances. And by now, over the last 5 years, the shipping lines have actually learned how to, play along depending on the scenario. So right from the time the COVID struck, and then the Red Sea crisis, and the US tariffs, and now the Iran-Iraq conflict, Iran-Israel conflict. So we've been actually deploying and redeploying our fleet depending on the current, on the scenario at that point in time. Now, let's break it up into two parts. One is the Suez Canal, the Red Sea and the Suez Canal, Bab al-Mandab, and the other one is the Strait of Hormuz. Now, as far as the Suez Canal is concerned, most of the shipping lines have already diverted their ships over the Cape of Good Hope. So over the last 1.5 years, most of the lines are already flying the ships around the Cape of Good Hope rather than going via the Suez Canal. So if that's a fear that the freight rates will go up because the lines have to now go over the Cape of Good Hope, barring a couple of lines, by and large, all of them have already moved over the Cape of Good Hope. So that's done. So I don't think that is going to change or make any difference to a great extent. Point number two, the silver lining on the cloud is that over the last 1 year, the freight rates have also dropped. Like, for instance, to Europe, the rates have dropped by about 50%. And to the US, they have dropped by about 33%. So, again, this fear that the rate levels might go up or whatever it is, they are still at this point of time lower than what they were the last year. So your base is low at this point in time.
These are container rates.
Point number two.
These are container rates? Container.
The container rates. I'm talking about
container okay. Rates, please go on.
Yeah, thanks. And as far the other one is the Strait of Hormuz, the Persian Gulf, the upper Gulf. Now over there, most of the lines, the large carriers, they're all long-haul carriers, so they don't essentially cater only to the to that sector. The lines that do call there to Jebel Ali are essentially calling for transshipment services. Now, as of today, there is no war risk or anything that's a premium that's been announced. The insurance companies have not increased anything, but we got to wait and watch how the situation goes. And also the bunker costs. Bunker costs could possibly go up. They already started moving up. So we can't rule out, to what extent those costs will go up and then to what extent that will be passed on to the trade. But as things stand, nothing has changed. But these are really uncertain times and it's really too early to say anything. So I would keep my fingers crossed. But I would say it's a matter of concern, but it's not a panic situation. Thank you.
That's great context. So what you're saying is that container lines anyway were most of them because of all the Houthi attacks, etc. I think anyway they were plying around the Cape of Good Hope.
Yes.
So whatever impact had to happen has perhaps happened. And you said that year on year, container freight rates are down by how much?
So by about, I'm giving approximate percentage, about 50% as far as India to Europe is concerned, and by about 33% as far as India to the US is concerned. So, so if you give me 2 minutes more, while we talk about the US tariffs, and we are also concerned simultaneously about the US tariffs, so there also our base rate levels are currently lower than what they were last year. And of course, as per the latest news, we are hopeful that some sort of an agreement would be in place, which would be mutually beneficial. So let's hope for the best and take it forward from there. Thank you.
Okay, fair point. Let's just bring in Mr. Dushyant Mulani into the conversation as well. Mr. Mulani, what's your assessment? Hearing Mr. Vaswani, it seems like at least for now, at least on the container side, there is no immediate threat of a huge rise in freight rates. What is it that you're hearing? And I don't know if you're looking at the tanker market as well. Could there be some issues there? Oil prices are rising, but the Strait of Hormuz is still open. Your thoughts?
Yes, thank you. Good morning, all. First and foremost, I definitely respect what my friend Sunilji has conveyed here. Point is that this conflict is very volatile. Nobody knows that how long this is going to last for. And the repercussions of this will be known to the entire logistics sector and trade and industry in next week or so. That's my assessment. We've been talking to a lot of people on the global front, in the region rather. And the Strait of Hormuz, which controls approximately 20 to 25% of global oil supplies, there will definitely some disruption is expected very soon. As far as the Indian trade and industry is concerned, these kind of events, global events, do throw up challenges, and India needs to build its own logistics security, which is very crucial, as important as defense or food security for our country. Whether it was Red Sea or earlier conflicts or COVID, that time Indian exporters have faced cost escalations. Fortunately, past 12 months, there has been softening of freight rates. But this challenge, which is there at present, where it is going to lead to, it's too premature. We are in very active dialogue with the Ministry of Commerce and Ministry of Finance. We are trying to work out and envisage how these shocks can be absorbed by Indian trade and
Mr. Mulani, if I can just come in, you said we are expecting some disruption in the Strait of Hormuz.
Yes.
Is that the chatter within the shipping community, that or is that like an educated guess?
No. Rather, it's the feedback is coming from the trade and industry side quite a lot, from the logistics sector, and across the region. Just last night, we had a detailed interaction with our peers in that region, Middle East region. And they are quite worried. People are taking a very cautious note because in that Strait of Hormuz, which at the narrowest point is about 33 kilometers between Oman and Iran. That's been a very troubled point. And the signals are coming up. People are taking a very cautious note of it now.
I mean, there's no way to know, as I said, in terms of what's going to happen. But Mr. Vaswani, that is a bit of a choke point, especially important for oil more than anything else. What's your sense, sir?
You've hit the nail on the head. It's more for oil, and that's why I touched upon the topic of bunker prices, because then that would impact everything. That would impact container shipping as well. As far as Iran is concerned, of course, this is my personal opinion. No one knows what's going to happen, but at least Iran or the Houthis may not necessarily strike, because it will only hurt Iran's supply of oil or the supplies into the Gulf. But what could happen is, in the crossfire between Israel and Iran, if some of the missiles or some of the bombs just hit the ships, then that would be dangerous. Then, because then the ships would possibly back off, and they might cut their services, or the ones that do operate would certainly, of course, definitely impose war risk premiums, and the cost would rise. The services could get impacted. But as I said, as of now, the services are still going on. Even till yesterday, the ships that had to ply there have been plying. So let's wait and watch.
Let's hope it doesn't come to it. But I think, as both of you acknowledged, no one really knows in terms of how this is going to impact things. I think everybody's just sort of looking at the last two instances of flare-ups when it's been pretty limited. I mean, the impact has been limited and short-lived. And I guess that's what you can go with. Because otherwise, I mean, the consequences could be more severe. Mr. Vaswani, thank you very much for joining us and explaining to us the state of affairs right now. And Mr. Mulani, thank you very much for the feedback that you've gathered and your perspective on the matter as well. Well, I think, what we're going to do is take a quick commercial break here. Markets have flatlined, nothing on the indices at least. Broader markets, of course, down more. Manisha is going to come in and talk to us more about commodities. Stay tuned.
Welcome back. So the equity market has given up much of its early opening gain. Let's figure out what's happening with commodities. We have Manisha joining in. Manisha, of course, it's this West Asia conflict that everyone has has their eyes on. You tell us, for commodity, I mean, what does it mean?
Well, a couple of things really, and two things that have continued to gain. One is gold. It's $50 away from its all-time highs, and the other is the crude oil prices. We've been talking about it constantly. I'm just going to get into drill deeper into details here, where we did see 7% of gains in the previous Friday for the crude oil prices. With that, it was 13% of gains in the previous week. It's a second straight day of very strong gains continuing for the crude oil prices. But importantly and interestingly, while we did see 78.5 on the higher side on Friday, we are trading below 75 at this point in time. So even as weekend did bring in a lot of more information and news, we haven't seen the crude oil prices take a lot of support from that. Well, while of course there are fears and there are fear premiums being built into the crude oil prices that the escalating tensions could disrupt supplies from Western Asia, there also was one interesting report, and they did give a spike to the crude oil prices. That was that the Israel attack on giant South Pars gas field in Persian Gulf has led to one of the platforms getting shut there. Not too much of an impact coming in from there. Trump also has warned that there could be more restrictions on Iran oil going forward. Also, if it attacks U.S. facilities in the region, then there would be higher repercussions on that. And then the markets also have seen Trump trying to set up dates for the coming weeks as that 90-day period gets over. The markets also have seen very strong volumes coming on Friday. We haven't seen a repeat performance of that happen today. But August 2025, $80 call option saw 33,000 contracts on that. The total contracts were 66,000. And of that, half of that in sense of options market went into 2025, $80 there. Now, if the prices have to go higher from here, you will need to see more fresh longs coming in. What we saw on Friday was shorts unwinding their purchase positions, but there were no fresh longs into the trade there. The second, if there is a direct attack on the oil facilities, on energy infrastructure, then you will see crude oil prices going up. Or if it is about a broader regional conflict and more countries start to come together taking sides, then you would be looking at crude prices going up. Until that doesn't happen, markets do not believe that you're touching $80 in a jiffy when it comes to crude prices. Now, Strait of Hormuz, of course, has been an important conversation, but remember, we keep telling you that it never really has been shut. There have been days when we've seen delays in sense of Strait of Hormuz, but that 18 to 22 million barrels per day that we see passing through that area never really has seen any shut there. And Iran, of course, is important. It produces 3.3 million barrels and exports nearly 2 million barrels per day of crude and condensate and fuel as well. And the markets do believe that it would continue to come in. What you really need to watch out going forward from here is Iran telling mediators that it is not open to ceasefire negotiations while under Israel attack. The second thing you will need to watch out is the G7 meeting, where the Israel-Iran agenda is on top here. And then apart from that, it's a barrage of monetary policy meetings happening in this week. The top, of course, is the Bank of Japan. That happens tomorrow, likely to leave interest rates unchanged. The second important meeting, of course, is the US Fed on Wednesday, where there would be a signal of whether or not there are further rate cuts coming in the month of September. And then it also has to be about China's central bank, where they are going to decide on loan prime rate. You also have Swiss National Bank, Bank of England. So there are 6 national banks or central banks meeting in this week talking about monetary policy, and much of an impact on real estate, asset classes and currency would come in from these.
All right, Manisha, thank you very much for that. So that's commodities in focus, and they very much remain top of mind across the board. Well, let's focus on some stocks as well. The market's not doing very much, but stocks are. Tata Motors is the first one we want to talk about. Sud is here with details. Good morning.
Morning, Prashant. So Tata Motors is top Nifty loser, is down 5%, and it's on the back of because JLR is holding investor day. JLR, remember, contributes 70% to Tata Motors' total consolidated revenue and almost 80% to its profit. And today, ahead of its investor day, JLR has released its outlook for FY26. And by the first look, that outlook is looking muted. On the EBIT margin front, company is saying that in FY26, EBIT margin is going to be in the range of 5 to 7% against 8.5% that company has reported in FY25. On the free cash flow, it's saying that it's going to be close to zero in FY26 versus 1.5 billion pounds reported in FY25. But company is expecting both EBIT margin and free cash flow to improve going forward after FY26, basically over FY27-28. And its medium-term target on the EBIT margin is to get back to 10% level. Now, on the US tariff also, company has made certain comments. It's saying that it continues to engage with both US and UK governments. On UK exports to US, tariff is going to reduce to 10% from 27.5%. But another major market from where JLR exports is Slovakia, for where exports tariff remains around 27.5%. Also on China market, it says that while premium market faced challenge in FY25, JLR has outperformed the market, and going forward, it's looking to unlock growth in China via licensing of Freelander to its JV, that is JLR's JV in China. Also, it has made certain comments about order intake and leads for Range Rover, where it was up 37%, order intake was up 15%. Similarly, for Sport, order intake was up 34%, leads were up 39%. And lastly, on the investment front, it's saying that by FY28, it's going to invest total 15 billion pounds. So overall, as far as outlook is concerned for FY26, it's muted, and that's the reason you are seeing a big downtick.
That explains the near 5% drop on the stock. Sudarshan, thank you very much for that. That's Tata Motors in focus today. Well, this is a stock on the way down, but a stock which has positive news flow and commentary around it is actually PI Industries. PI is up 4%. That's because Morgan Stanley has turned quite constructive on PI. Let's find out why. Ria, tell us, what is Morgan saying?
Well, yes, Surabhi, Morgan Stanley has come out with a note on PI Industries today. They've upgraded the stock to an overweight rating with a target price of rupees 5,000. In fact, they've also raised their multiple on PI's agrochemicals segment to 23 times, and they've raised the segment earnings target by 7%, which was actually offset by the drag in the company's pharma segment. Now, Morgan Stanley has said that PI has the highest exposure to agrochemicals in their coverage, and they believe that the company should see a three-pronged volume increase across domestic exports and the new molecules businesses as well. They've estimated that the new molecules and biologicals segment will each comprise a third of custom synthesis exports and domestic portfolios by FY28. They also think that multiples can re-rate 20% higher to levels seen around, between 2022 to the first half of FY24, which was a period of robust exports momentum for the company. So overall, for the industry, they do expect a more constructive volume-led agrichem cycle in 2026, which is going to support stronger asset runs and operating leverage-led margin tailwinds as well. And out of the entire segment, they are positive on PI Industries, and the stock is resultantly higher in today's trading session.
All right, 4%. That's a big one in a market which is absolutely flat. Thanks very much, Ria, for that. We'll take a quick commercial break here. We're going to come back in just a bit. It's the economy with Lata on the other side, and she's going to be speaking with Ambassador Navdeep Suri about the likely course of the Israeli-Iran conflict and, of course, implications for India and the region. Stay tuned.
Welcome to It's the Economy. The most important topic today, the escalation of missile strikes between Israel and Iran, which has worsened hugely over the weekend. And there doesn't seem to be any end in sight to the war as of now. Casualties on the Iranian side seem to be higher, both in human and, more importantly, in economic terms as well, with Israel bombing South Pars, the world's largest gas field, and hitting a key processing unit. The only ray of hope, if one can call it that, is President Trump tweeting late on Sunday that, and I quote, Iran and Israel should make a deal and will make a deal. We will have peace soon between Israel and Iran. Many calls and meetings are now taking place. Well, to understand the triggers for this war and how and when it may end, I have with me Ambassador Navdeep Singh Suri, a retired diplomat who has served in India's diplomatic missions in Cairo, Damascus, Washington, London, among other countries. Ambassador, many thanks for joining us and giving us your time.
Pleasure to be with you, Lata.
Well, so if I can start by saying at the outset, after looking at the last 4 days' flow of news, does it look like we have a prolonged conflict on our hands?
I don't think so, because I frankly don't think that Iran can sustain a prolonged conflict, considering the rate at which its missile delivery capabilities, its energy facilities are being degraded. In a funny way, even though Israel is a small country, it's an unequal contest, because Israel is a technological superpower. It is the military superpower in the region, and it enjoys the unlimited backing of the Americans. Whereas Iranians, a lot of what they have put together is largely their homespun jugaad. And so I think there are limitations within which the Iranians will be operating. And I wouldn't be surprised in a couple of days' time, once Iran has had the psychological satisfaction or the moral satisfaction that they've landed a couple of blows, that people start looking at pathways out of the current situation.
Will it go to a point where the Israelis or even the Middle East looks for a change in the regime in Iran? Will that be the way this will end? Or will it go that bad?
Hard to say at this point of time. Whatever chatter I am picking up, even Iranians who are disgruntled against the regime for very valid reasons, whether within Iran or outside Iran, seem to, at this point, feel that what Israel is doing is attacking Iran, not just the regime. And so people are kind of tending to get united behind the country rather than just the regime that they may not particularly like. So I think that's a question mark. There is no love lost for the Iranian regime in the Arab world, I must say, not just with Israel. They have been guilty of interfering quite blatantly in the affairs of neighboring countries, starting, of course, with Iraq, but then Syria and Lebanon and Bahrain, and the Saudis have their own angst. But I don't think we are at that regime's change moment yet, though nothing would please Netanyahu more than a regime change in Tehran.
Okay. Well, how seriously should we take the U.S. president's tweet that talks are happening and, peace will come, the war will end? Are you expecting a quick end, as in a couple of days?
Should we go by the past record of the president's tweets and and draw our conclusions from that? I think we've all learned that the Ukraine conflict wasn't solved in 24 hours. And he claims to have resolved India-Pakistan, and certainly he thought he would resolve the long festering issues of the Middle East. The reality is that these are very complex issues, and they need months and months of fine negotiations by experts to try and come to some kind of a resolution. So on your particular question, I'd take President Trump's tweets with a very large spoon of salt. I think, Lata, the larger issue, perhaps, for a channel like yours, is that if Iran is driven to a point of desperation, and it has in the past threatened that it could block the Strait of Hormuz. Then we really need to look at what the consequences could be, because those are, to my mind, that is the single biggest regional and global ramification that could emerge out of this.
No, actually, Ambassador, that was going to be my next question to you. Do you think Iran would threaten that and even actually execute that threat? Do things get that bad?
You know, it is their extreme option. They've done it once before during the Iraq-Iran war. The consequences today could be much worse. You know, between the Saudis, the Kuwaitis, the Qataris, and the Emiratis, they ship about 21 million barrels a day out of the Strait of Hormuz. That's 1/3 of global seabound oil supplies. So, you know, some analysts say that should Iran take that extreme step? And it is a doable step. You know, when you look at the shipping channel that takes you through the Strait of Hormuz, that's barely 3 kilometers, not even 3 kilometers wide. So you can knock out a couple of tankers and effectively block the channel for a while. And that would really send shockwaves through the global system. I think it would also make us painfully aware that even today, after our strategic petroleum reserves in Visakhapatnam, in Mangalore, and Padur, our own oil reserves today, the strategic petroleum reserves, are barely 10 days requirement for us. So, you know, that really is an extreme situation. And, you know, I just hope that the Iranians are not pushed to a point where they feel that that's the only option left for them.
Mm-hmm. Okay, but, you know, that's the side which the US also will take. I mean, even for the US, the rise in oil prices is anathema for the president. That was one of his big promises, that he will keep crude prices down. So clearly, they will work in that direction. But regardless, your base case now is that this will not be a prolonged conflict because Iran can't afford it. That is a very big consolation you're giving the market.
I think so. I think, you know, Iran's capacity to sustain a long distance conflict of this nature, given the technologies that today are available, the means that are available to Israel to keep degrading Iran's energy infrastructure, keep degrading its missile capabilities. And combined with the fact that Israel itself has a very robust anti-missile defense system. You know, if you look at the hundreds of missiles that Iran has fired at Israel and see how many actually managed to penetrate its air defenses, it's a fairly small number. And Israel would probably feel that it can absorb that much of the pain. But I think for Iran, the situation continues to become more and more grave. And that's what I feel, that it would be hard beyond the next 3 or 4 days for Iran to be in a position where it can deliver major blows to Israel.
Okay.
And would probably, you know, that's why I say that both sides will be looking for a pathway out at that point of time.
Okay.
I don't think, and the Israelis curiously have also acknowledged that they don't have the capacity to knock out Iran's nuclear capacity. They've struck Natanz, but they can't do very much about Fordo. So, you know, it's not as if Israel will be able to claim victory that I've destroyed Iran's nuclear program.
That indeed is going to be my last question. Are there any, you know, compelling reasons why Israel also will want to just end? Was the whole idea just to give Iran a warning that they should not continue to help Hamas or any of the other outfits? Was it a limited attack, even from Israel's point of view?
You know, there should be a lasting, enduring lesson for Israel somewhere in all of this, that you know, it's easier to start wars than to achieve objectives. I think Gaza is a stark reminder that after 20 months, Israel still hasn't been able to destroy Hamas. So you know, you can win battles on the battlefield, but whether you win the wars, I think, is the moot point here. And I don't think Israel achieves its objective of destroying Iran's nuclear program. That's why
the 5+1 nuclear agreement was so important, which was done during the Obama government, that it put caps on Iran's nuclear program, which were verifiable. And then Trump comes in, Trump 1.0, and tears up the agreement and leaves the Iranians free to start increasing beyond those caps their enrichment program, and puts you in the situation that you are in today. So, there is a room for diplomacy to achieve objectives that you may not be able to achieve through war. And you've done the war, and you will again probably have to fall back on diplomacy to take you forward.
Yeah. Well, the key leaders are meeting in Canada for G7, and hopefully everyone will prevail on the US president to prevail upon Israel. Let's hope your guess will prevail, that on both sides there will be compelling reasons to restrict this conflict to fewer days rather than a prolonged war. At the moment, crude at $74, $75 is still manageable. Let's hope it doesn't go to a point where the Gulf of Hormuz is blocked and things are escalated beyond economic sustainability for many of us. Thank you very much, Ambassador, for joining us.
Thank you, Dada.
Okay, so that's the key point. Hopefully, both sides don't have a reason to prolong this conflict. That's it on this edition of Fix the Economy. After break, Chartbusters.